Jeremy Siegel is a professor of finance at the Wharton School at the University of Pennsylvania. He's also the author of the best-selling book, Stocks for the Long Run. Jeremy, always great to see you. And every time we talk, you make the case that we're going to go higher. So make this case again that we're going to see Dow 20,000 when almost everyone I've talked to, Professor, say that profits are going to go lower.
Well, we are certainly closer to fair market value than at any time over the last 5 years. I think my calculations say that Dow 20,000 is fair market value. It certainly is higher in terms of the price-earnings ratio than the long-run averages. But once you consider interest rates, and even if the Fed begins to raise interest rates, they are still far lower than the average of the post-war period. My calculations say that we could have 18, 19, maybe even 20 times earnings, and that gives us pretty close to Dow 20,000, and that's why I say it's fair market value. Now, we all know in the short run, it could go down to 16 or 17 before it gets there. It might take 2 years instead of 1 year, but that's where I think it should be.
Okay, but is that the peak, Professor? Because as you note, even though the Fed is going to start raising interest rates, once they do, the trend is going to be up. So does that necessarily mean that Dow 20,000 is your peak?
Well, not necessarily. When the Fed starts raising interest rates, and, it may be June, it may be September, bull markets usually continue anywhere from 9 months to 2.5 years after they begin to raise the rates. So beginning to raise the rates, to me, doesn't signal the end of the bull market. Also, speaking to your good question about earnings, earnings have been challenged by 3 factors. First of all, the collapse in oil prices, certainly the oil firms and the oil drilling. We have the high dollar. We also have pensions. There's been a lot of charges in the fourth quarter and extending through 2015 because of the low interest rates and the increasing the age assumptions that pensions must use. This happens every 4 or 5 years, and it had to be incorporated. So those 3 factors, I don't think they're one-time factors that I don't think are going to continue to hit earnings in the coming years.
All right, Professor, let's talk Nasdaq 5,000, okay? Because now it's got people talking about whether we're in a tech bubble or not. I referenced Mark Cuban. I don't know if you saw his blog post yesterday, but here's what he says about why he thinks we're in an even worse tech bubble today. He says, quote, "If we thought it was stupid to invest in public internet websites that had no chance of succeeding back then, it's worse today. The bubble today comes from private investors in companies," he says, "that have zero value." What do you say to that?
Well, I think he's referring to private equity, the funding that we get for new ventures. I don't think that's necessarily at all referring to the public markets. I mean, we may argue that Twitter, Facebook, and some of those, but they're still making profits compared to 2000 when these companies were on the exchange and not making any profit. I don't see, the price-earnings ratio of the Nasdaq back in 2000, I saw one, in fact, on a Bloomberg screen that I use, was up to 600. It's 30 today on 2014 earnings, 20 on this year's estimated earnings. That's a huge difference.